For more on this, we're joined by Nour Hammoury. He's Chief Market Strategist at Equiti Group. Welcome back, Nour. Now, the pressure is on for Nvidia with its results set to be a key test for the broader tech sector. What will it take to actually impress investors this time round?
Good morning. Thank you for having me again. The bar for Nvidia is incredibly high right now. I mean, the company itself guided for roughly about 91 billion in the quarterly revenue, while the market consensus is about 92 billion, almost double the level from a year ago. So simply beating expectations may not be enough anymore. I think investors will focus on three things: forward guidance, margins, and whether AI spending remains sustainable. Nvidia's data center also business generated a record of 75.2 billion last quarter. So the question has shifted from, is there demand for AI, to can this extraordinary rate of investment continues? And there is also what I think is particularly interesting. The options market is pricing only about 5.4% move after earnings, which is below Nvidia's historical post-earnings average, which is about roughly 7.4%. That tells us that the market is becoming accustomed to spectacular numbers. So Nvidia's problem isn't delivering good earnings anymore. It has to deliver numbers that changes the expectations for the entire AI investment cycle.
One asset outperforming its peers is Bitcoin, which has climbed to over $80,000. What's fueling the renewed risk appetite for crypto, and how sustainable is this rally?
What's interesting about Bitcoin, Bitcoin's move above 80,000 is that I wouldn't even describe this as a purely renewed risk appetite. Bitcoin is up roughly about 28% this month, or in August, but a major acceleration came in after the U.S. Treasury announced larger purchases of long-term dated government debt that pushed long-term yields temporarily lower, and of course weakened the US dollar. So we're seeing the return of what I would call the debasement trade. Investors looking at high government debt, interventions in the bond market, and weaker US dollar, and moving also towards scare assets. And this is why we've seen a strengthen not only in Bitcoin, but look at gold, silver, even platinum, and other commodities. Institutional also demand has returned. A US Bitcoin ETF recently recorded 5 consecutive days of inflows, totaling about 2 billion, while short covering also has amplified the move. The sustainability test is now straightforward. If ETF flows continue and the US dollar remained under pressure with yields, I think Bitcoin can extend the rally. But after such a rapid move, 80,000 is no longer just a target. It becomes an important test of whether buyers are willing to stay in at these prices.
Another catalyst traders are watching is Federal Reserve Chair Kevin Warsh's speech at the annual symposium in Jackson Hole later this week. Will markets get the clarity they're looking for?
Very important question here. I actually think markets may be disappointed if they're expecting a clear signal on the next interest rate move from Kevin Warsh. The Fed kept rates, as you know, between 3.5 and 3.75 in July. But most importantly, three policymakers wanted about 25 basis point rate hike. And the minutes also showed a growing concern about inflation. At this time, the labor market has weakened. So Warsh is dealing with two competing risks. Inflation argues for a tighter policy, while employment argues for caution. And there's another layer now. Long-term Treasury yields have become also increasingly influenced by fiscal concern and Treasury interventions. So Jackson Hole isn't only about whether the Fed hikes or cuts next. It's about whether investors still believe the Fed can anchor inflation expectations independently of a fiscal policy. Warsh has already been also very clear that the 2% inflation remains the target. So here, the added value for the market also will not necessarily be a rate signal, but what they need from Jackson Hole is what would make the Fed tighten and what would make it ease, and which risk the Fed is willing to take, inflation or employment, that carries more weight on the policy next.
Great to have your analysis, Nour Hammoury. Thank you very much as always.
Thank you for having me.